Hi, Dominique. Thank you again, and welcome everyone to our kind of week ahead with Dominique around data, Fed policy, and things to look out for the coming week. And as we've done the last few weeks with the Russian invasion, particularly, and hopefully, obviously, people are still focused on what's happening in Ukraine and the potential impacts. But right now, it's Saturday, March 19th. In the afternoon, late afternoon in London, and kind of, I guess, midday in California. So nice to see you again, Dominique. And
nice to
maybe
see
let's start. Obviously, it's as most of the weeks recently have been quite eventful. So from a Fed policy and kind of what's your take on everything, and also kind of what's your take on how the markets have been digesting the FOMC meeting.
I actually agree with the markets. They think that Chair Powell is going to be forced to pick up the pace of tightening. And based on the reactions to the FOMC, I think it's likely. You know, right now, Powell is planning 25 basis points. Each of the meetings we have left in the year. The market is thinking it's more like 3 hikes between May and June.
Okay. But one of them is a 50. One of them is a 50.
Yeah.
Okay.
And I think the market is right for a few reasons. Number one, the Fed has this tradition of consensus. I mean, in the UK, the governor of the Bank of England at times has been outvoted by his committee. It's never happened in the US, but here we have a Fed chair who lets his FOMC members go out and publicly discuss the details of monetary policy. It would never have happened under Yellen. And in fact, if you read the transcripts, if you are enough of a nerd, as I am, to read the transcripts, you see that she is really telling off her committee members and saying that they have to keep the discussions internal. So we have, and also we have a chair who carries less intellectual credibility and weight than the previous chairs. I mean,
right. So it seemed very strange, some of the comments that were coming out, like right after the FOMC, saying we need to move more, we need to move much faster, and
so definitely, and to me, the most surprising one, and which I really didn't expect, was Waller. Yeah. Waller is a board member, and in the past, you've had dissent at the Fed, but always from the bank, the regional bank president, who do not enjoy the same status and intellectual prestige as the board members. And also, they vote at the FOMC on a rotating basis, by contrast with the governors. So I was really surprised by the post-FOMC comments from Waller, who said the data, I mean, I'm literally quoting verbatim here. He said the data was screaming for 50 basis points, but because of the geopolitical risk, it made sense to do only 25. And that's why I supported 25, because we had only one dissenter who was Bullard, which was, no big surprise.
Yeah.
And Waller just voted with the majority, despite, having made very strong public statements that 50 would be more appropriate. And so,
do you think some of that would be because some people in the FOMC said, we're in a fragile environment with everything going on, and if we went 50, the markets, or even signaled being more aggressive, the markets would sell off significantly, and this could be a downward spiral. And clearly, the markets rallied. But I think, he's not a trader. He's not, could that have any impact or not really?
So on the Fed decision making, definitely. On the economy, I'm less sure, because if you look at the S&P, it's down about one half of 1% since the war. So it's hard to argue that, the market are super sensitive to the war. The market are still seeing this as a contained conflict. And that's why I think that, comes the next meeting, which is in early May, Waller is going to have a hard time supporting 25 basis points because, either the situation will have really escalated in the Ukraine, and then we will be in a completely different macro environment, or, it will be where we are now, and a market probably not much changed. And then, why then be worried by the geopolitical risk, which really won't have changed much. So if we stay clear of an escalation where, the use of nuclear weapons becomes less of a tail risk, I think we are in a completely different macro environment. But if we are still in the contained conflict context, and we are in a situation where, it's very likely that the CPI, at least on a non-seasonally adjusted basis, is probably going to be very close to 1% month from month in March. So at that stage, it's really hard to justify the 25 basis point. And so I think that either Waller will openly dissent, or, there will be such a strong push from FOMC members for 50 that Powell will find it difficult to resist.
Right. So is 50 at the next meeting your base case now?
Yeah, yes, I'm getting there. And then the question is, should you not do 50 at the June meeting as well? This reminds me when I was an economist with the IMF, and we would go to emerging markets trying to convince people to tighten when inflation was out of control. And we would say that, if you tighten preemptively, you will have to tighten less, and you reduce the risk of hard landing. And I found that the US is exactly in this situation. We have a supply shock, a new supply shock from the Ukraine war, and everybody is focusing on oil, but it's going to have also a huge impact on wheat prices. I mean, between the two of them, Russia and Ukraine are like the biggest producer in the world. I mean, since the antiquity, wheat was coming from that part of the world. So yeah, we have domestic, we produce.
Yeah, there's a lot. Plus, you have the
prices go up. Global
lockdowns in China. There's more questions on the supply side, definitely.
Exactly.
One question. I mean, obviously, it depends upon the presser after and everything. But so if they go, I guess how it goes into it. But are you surprised that do you envision that the curve keeps flattening?
So the curve, in my view, is already based on the policy trajectory that is in the SCP. So based on Powell's current plan, in my view, the curve is too flat, because we are not talking about a real tightening here. And that's another reason why I think Powell is going to have to pick up the pace, is if you look at the projection in the SCP, they're really inconsistent. And it's hard. I mean, you had Larry Summers in the Washington Post blasting, with all his guns, blazing the SCP, and Summers is Summers. But it turns out, I think he has a very strong case. I mean,
he's not the world's most likable guy, but to be fair, he's kind of been, I mean, listen, we say he's right, and people say, well, this person was right about inflation, but there are a series of factors, mostly, well, supply and demand side, but a lot from the supply side, which people could not have predicted.
So totally,
15 months ago. So
Totally. Summers is right on inflation for the wrong reasons, basically.
Yes, exactly. That's exactly my point.
He never foresaw that the supply issue would be so pervasive and long-lasting. But he's getting a little bit, he's lucky.
Yes, is lucky.
So, but on the issue of the SCP, he called out the inconsistencies, like the unemployment rate remaining at 3.5% over the projection period, the real Fed funds rate falling further. I think he's spot on. And this is, after all, a debate, an economics debate. And I think the Fed has just lost a lot of credibility by publishing this forecast. And there is going to be a big pushback from the whole economist community, not just Summers, because this is so obviously an inconsistent forecast. And that's another reason why 50 is likely in May. And so back to your question, is the curve going to flatten more? So in this tightening story, we've had really two divergent market view. You had the equity markets that took the tightening in stride, rallied after the meeting. And then you had the bond markets that seems to be saying, oh, this is terrible. And to some extent, I think each market is in a way talking its book. I mean, no analyst like to see its the asset class that she's covering go down in price. So I think the fixed income market is a little bit unduly alarmist because I just don't like to see bonds lose value. So in my view, the flattening was not warranted based on what we currently have, because it's such a mild, it's not really tightening. Come on, the Fed is lower, the real Fed funds rate in its forecast. So in my view, 50, actually, given that the curve was too flat before, more realistic assessment of what 50 basis point would do to the path of the economy should not lead to curve inversion or more flat.
Makes sense. And then from a political standpoint, obviously, I guess Raskin withdrew her, or President Biden, I guess, withdrew her nomination. That is generally, I guess, positive for everyone else getting through. And
so yes and no. So after she withdrew her nomination, the 4 nominees were cleared by the Senate Banking Committee, and it's now going to a full floor vote. And I think we'll find out this week when the vote will be held. And I think with Powell, Brainard, Jefferson, they'll get through. The question mark is Cook. She got no vote in committee from the Republicans. And I suspect she won't get a single floor vote. So this is once again going to be down to Senator Manchin, I think, because he's the most centrist of all the Democratic senators. She needs every Democratic senator.
But I thought he said he would support her, or no?
I will see it when I see it. He's a little ambiguous, and she obviously would be a ultra dovish board member. She's a Black Lives Matters activist, so she'll support, bringing down the unemployment rate as politically feasible as. We find out this week, because I suspect what's going to happen is that the chair of the Senate Banking Committee, Senator Brown, is going to basically rally the troop and sound Manchin before putting the nomination to the full Senate floor.
Okay, so let's move to the upcoming week. So I guess if you want to elaborate anything there, what's the most important 2 or 3 things that investors should be looking at or be concerned about this week?
Okay, so
certainly from a data and Fed stuff.
So besides the war, obviously, and by the way, to me, the most likely outcome at this stage is that we get a sort of a ceasefire without much sanction relief. So besides that, we have the capital goods order, which is interesting because it's quite correlated with capex, equipment capex. And also, it's been very strong since the pandemic and unusually decoupled from unemployment. And I think because the investment we are seeing is not so much about increasing capacity, but much more about substituting capital to labor and also
automation.
Exactly, and trying to make businesses pandemic proof. Otherwise, we have the slew of usual business surveys. We have the market. We have the Kansas Fed, the Richmond Fed. It's not the most important data. I mean,
home sales, is anyone, because now obviously people are talking more and more about higher mortgage rates, or is this not the super important number?
It is important, and in fact, this is going to be my next, I think, weekly topic, how the policy tightening is going to hit the US economy, because in fact, there are very few channels for interest rates to hit the economy. And interestingly enough, the relationship between the curve, for instance, and bank profitability is changing because of the composition of bank assets. So the traditional transmission channels have changed. So definitely the housing market is the most interest sensitive part of the economy. But there is a backlog of demand. So it could take time for the percent plus. But yeah, you're spot on. I'm keeping an eye out. I've been keeping an eye out for the residential real estate market data. Not seeing much, but that's where the next hit is likely to come.
Yep. Definitely. And University of Michigan sentiment, is that?
Oh, it's just a revision.
Okay.
It's just a revision of their initial. I mean, the confidence is down. I mean, is that surprising?
Right, it's the same.
When gas is so expensive, and the UMich Consumer Confidence Index is much more sensitive to inflation than the Conference Board. Right. So down.
Okay. And then any of the specific Fed speaking again this week?
Of course, we want to hear Powell. Otherwise, the really interesting one, I think, is Waller, because he's a board member, and I want to see whether he's really going to campaign, for 50 next month. But he's not talking. I mean, we have the more hawkish members, so Bullard, Barking, Mester, but no surprise there. Maybe we should pay more attention to the traditionally more dovish members, Williams and Daly, because if they change their tune, it means the rest of the committee is behind them. But yeah, that's it.
Sorry, who are you saying that was making the case that's for a more hawkish?
So the person who is really, I think, the pivotal vote in a way is Waller, because it's so unusual.
Waller, okay, fine.
For a board member. Sorry, but he's not talking next week, unfortunately.
But he talked at the end of this week,
Yeah, but so the really interesting one next week are the dovish ones. If they turn, the rest of the committee will turn.
Yeah. Okay, cool. Anything else? I mean, I saw obviously you're including the continuing decline from COVID cases, hospitalizations, even hospital shortages. By the way, in the UK, I think it's still low, but some of these numbers are coming up. But I think hospitalization, everything is still very low. So I don't see any government policy changing in Europe. Yeah.
Totally. And unfortunately, this whole COVID has been, so hyped by the media. I mean, there's so much so many political careers, being contingent on where things go. So to cut through the noise, I strongly recommend our listeners focus on hospitalization, COVID-related hospitalization. And in the US, it's very clear they are still headed down. So you'll hear a lot of noise in the background with a new variant, AB, God knows what number. Yeah. But keep your eyes on the ball, and the ball is hospitalization. And here in the US, they are still falling.
Right. Okay, cool. Anything else?
No, I mean, it's this data-wise, this is not a very data-heavy week. Right. I think we need to pay more attention to Feds because that's where the potential.
Yes, and right now, then. Okay, yeah. I'll do as I've done a few recent ones. I'll just go back on a few kind of commodity vol thing. I'll just share my screen for a second, as a few clients had asked more about it. So one of the things I'm looking at first, I'll just show is this is the oil, WTI oil vol curve. And probably, as I've mentioned before, and I'm sure people who trade oil realize that traditionally oil skew, so puts versus calls, is bid well for puts, usually because the most active hedgers are their producers. And in fact, as some people know, there's certainly one particular emerging country, somewhat emerging, where their national oil company is extremely active. So in selling calls and buying puts. But in the current environment we're in, so that means that the put skew is higher than the call skew. But what in the current environment that we're in, you can see here, so this is, let's just take like August, at the money vol at 60, 25 delta is, so that's upside strikes. Let's say, I don't know, it's $115, $120. The vol is 65, and 25 delta puts, so downside, say $90, it's 58. That's pretty high, by the way, for skew in general. And this shows the market is absolutely much more concerned about a much bigger move to the upside than a big sell-off to the downside. So obviously, we've seen a big pullback over the last kind of 10 days in WTI as well. So this other thing I'm going to show up to people is, so, obviously we've had a move up from end of February. This is the June contract on WTI, from $87 to $115. So that's over 20% move, or about 20% move. And so you would expect skews move to the upside, volatility's gone up. But what's happened is we've seen a big pullback in a lot of commodities. So oil, palladium, even gold and silver, which we've talked about in the past. So we've had a big pullback in oil futures from 115 down to as low as low 90s. And then now we're just around $100 for the June future. So normally when you see a big pullback like this, and also the fact that, as I kind of had demonstrated or shown, the skew is for puts. So if you move from an at the money to down towards the put skew, so move down, and in this case, the future moved 15, 20% lower, vol should have become much lower. And in fact, also probably the skew would come lower. And I'll just show you another example. So gold, where at the height, so this is whatever, about 10 days ago, and 10, 11 days ago, volatility for 3-month, 20% upside on gold went from 35 vols and has been slowly trending back down as gold has come down. So this is upside strikes, and vol has moved down to 27. This is showing that the market is beginning to get less worry about a big move higher in gold, and which makes some sense. Equity markets have rallied. Sorry, the Federal Reserve has come and gone, so that's some uncertainty. But what's very different about oil, and I was just looking at this today, is this is June, say 115 strikes. I just choosing a random point on the curve. So everything I've told you should tell you volatility should have come down a lot. Commodities are less worried about a huge move. They've come back 15, 20%. A lot of questions about margins getting raised, people having to close positions, speculative positions. But in fact, this tells you this is the actual vol. Vol for this strike is still 71.6. And in fact, finished on Friday at pretty much the highest it's been. By the way, this type of duration and skew would be some of the highest vols we've seen in a very long time. And so this tells me the market is actually still very worried and still susceptible to a much larger move back higher in oil. For me, I still feel like owning oil upside is probably one of the most attractive trades, certainly in the commodity space. So something for people to think about. I'll stop sharing there. Hopefully people find that interesting. I don't know, Dominique, any other words of wisdom for the week?
Oh, I wish. I think you are spot on with your oil. And let's remember that oil is a super financialized commodity. So the sort of moves that we see are not driven in the short term by physical, supply and demand, more by expectations of market participants. But if you look at the physical demand picture, it's still not looking great.
It's still super tight. Yeah.
Oh, yeah, definitely.
Yeah.
So I'm with you.
Yeah, and like the potential demand destruction, which people talk about, well, a lot of countries, certainly in Europe and maybe even the US potentially, are talking about Germany and Italy. I think both we're talking about for gas and also potentially for petrol prices, that they'll help reduce those prices for consumers. So again, that's actually in some cases exacerbating the problem because they're not slowing demand. They're trying to help consumers by doing that, which means demand will stay high. And then there will be other questions, my guess, in the next week or two around a lot of players around shipping, about the trading companies, about margin requirements and what potential impacts that can have. So all these things are certainly worth looking for, and we'll be hopefully addressing a lot of these questions. Macro Hive, as always, we wish everyone a nice weekend, and please reach out. For us, the most important thing is to try and be there for our clients, and also get feedback from you guys and make our relationships as interactive as possible. So,
absolutely, thank you, Andrew.
Thank you, Dominique.
Good luck, everybody.
Yeah, good luck, everyone. Bye.